What would happen if the world woke up tomorrow and the US dollar was suddenly worthless?
Chapter 1. The Day Confidence Breaks. It does not begin with an explosion, a war declaration, or a dramatic political speech. Instead, it begins quietly, inside trading terminals, government offices, and bank dashboards around the world. A few numbers move in the wrong direction. At first, almost no one notices. Then suddenly, everyone does. In Tokyo, a currency trader watches the exchange rate screen flicker. The US dollar, long considered the safest and most trusted currency on Earth, begins sliding faster than usual. At first, the drop looks like normal market volatility. Currencies rise and fall every day. But within hours, the pattern changes. The decline accelerates. In Frankfurt, risk analysts at a large European bank start receiving automated alerts. US Treasury bonds, normally the most stable financial asset in global markets, are being sold at an unusual pace. Yields spike, liquidity tightens. Algorithms trigger defensive trading strategies. Across the Atlantic in New York, financial journalists scramble to understand what is happening. Markets have experienced crises before: the 2008 financial meltdown, the pandemic crash of 2020, regional banking failures. But this situation feels different. Those crises involved institutions, industries, or temporary shocks. This time, the problem appears to involve the foundation of the entire global financial system. The US dollar is not just another national currency. It is the backbone of international trade, the primary reserve asset held by central banks, and the unit used to price critical commodities like oil, natural gas, and many agricultural products. Roughly 60% of the world's foreign exchange reserves are held in dollars, and a similar share of global trade transactions are settled using it. In practical terms, this means the dollar functions as the operating system of the global economy. When countries trade with each other, they often do not exchange their own currencies directly. Instead, both sides convert into dollars. When central banks prepare for economic shocks, they store dollar reserves. When investors want a safe place to park trillions of dollars during uncertainty, they buy US Treasury bonds. The system works because of one invisible force: trust. Trust that the United States government will repay its debt. Trust that US financial markets will remain liquid and transparent. Trust that the dollar will hold its value better than most alternatives. Economists refer to this as confidence equilibrium. As long as everyone believes the dollar is safe, everyone continues using it. And because everyone continues using it, it remains safe. But confidence can be fragile. History has shown that financial systems can appear stable for decades before rapidly unraveling. In 1997, Asian currencies collapsed within months. In 2008, major global banks fell in weeks after years of appearing invincible. Financial crises rarely unfold slowly. They cascade once trust begins to erode. On this hypothetical morning, that erosion has begun. Central banks quietly start diversifying their reserves. Sovereign wealth funds shift portions of their portfolios into gold and other currencies. Commodity exporters demand alternative payment arrangements. None of these actions alone would threaten the dollar, but together they send a signal. Confidence is weakening. Within days, global markets become volatile. The dollar index falls sharply. Emerging market currencies surge unpredictably. Oil producers debate whether to continue pricing crude in dollars. Financial commentators begin asking the question that once seemed almost impossible. What if the dollar is no longer the center of the global system? For ordinary people, the early warning signs are subtle. Import prices begin rising. International companies delay contracts. Governments hold emergency economic meetings behind closed doors. But economists watching the data understand something deeper. If confidence in the world's reserve currency truly collapses, the consequences would not be limited to the United States. Because the dollar sits at the core of global finance, its failure would ripple through every market, every government balance sheet, and nearly every household economy on the planet. The global economy has relied on the same monetary anchor for nearly 8 decades. Now, for the first time in generations, that anchor might be slipping. Chapter 2: Why the dollar became the center of the global economy. To understand what a collapse of the US dollar might mean, it is first necessary to understand how the dollar became so powerful in the first place. Its dominance was not inevitable. It was built through a unique combination of history, economic strength, political stability, and global trust. At the beginning of the 20th century, the British pound, not the dollar, stood at the center of global finance. The British Empire controlled vast trade networks across Europe, Asia, Africa, and the Americas. London served as the financial capital of the world, and international commerce often relied on the pound as the standard currency. But two global events would dramatically shift this balance. The First and Second World Wars weakened the economic foundations of Europe. Massive military spending, destroyed infrastructure, and enormous national debts left many European economies struggling to recover. Meanwhile, the United States emerged from the wars with a powerful industrial base, a growing economy, and vast gold reserves. By 1944, as World War II was approaching its end, representatives from 44 countries gathered in New Hampshire to design a new global financial system. This meeting would become one of the most important economic turning points in modern history. The agreement created what economists call the Bretton Woods system. Under this framework, the US dollar became the central currency of the international monetary system. Other countries would peg their currencies to the dollar, while the United States promised that dollars could be exchanged for gold at a fixed rate of $35 per ounce. In effect, the dollar became a bridge between national currencies and gold. This arrangement provided stability. Countries could trade with predictable exchange rates, central banks could hold dollar reserves, and international markets gained a reliable reference point for pricing goods and services. But the dollar's dominance was not based solely on policy decisions. The United States also possessed several structural advantages that reinforced global trust in its currency. First, the US economy became the largest in the world. After World War II, American factories produced enormous quantities of automobiles, machinery, chemicals, and consumer goods. International trade increasingly flowed through American companies and financial institutions. Second, the United States developed the deepest and most liquid financial markets. US Treasury bonds became the safest and most accessible investment for governments, banks, and institutional investors. These securities allowed trillions of dollars to move quickly and efficiently through global markets. Third, political and institutional stability strengthened confidence in American financial systems. Independent courts, transparent regulations, and relatively stable democratic institutions reassured foreign investors that their assets would be protected. Over time, these factors created a powerful economic network effect. The more countries used dollars for trade, the more convenient it became for others to do the same. Oil contracts, shipping payments, international loans, and global investments increasingly relied on dollar-based transactions. Once this system matured, switching to another currency became extremely difficult. Even when the Bretton Woods system formally ended in 1971, when the United States stopped converting dollars into gold, the dollar remained dominant. By then, the global financial architecture was already built around it. Another development reinforced this position. During the 1970s, oil-producing nations began selling petroleum primarily in dollars. Because oil is one of the most important commodities in the world economy, this practice created constant global demand for the currency. Countries importing energy needed dollars to purchase it, which further strengthened the dollar's role in international trade. Economists often describe this phenomenon as the petrodollar system. Over the following decades, the dollar became more than a national currency. It became the default financial language of globalization. International debt contracts were written in dollars. Global corporations reported earnings in dollars. Even countries with their own stable currencies frequently stored their reserves in dollar-denominated assets. By the early 21st century, the system had reached remarkable scale. Trillions of dollars moved through foreign exchange markets every day. Central banks accumulated enormous dollar reserves as insurance against economic crises. Financial institutions across the world built their balance sheets around dollar-based instruments. This created a powerful cycle of stability. Because the dollar was trusted, it was widely used. Because it was widely used, it remained trusted. Yet history shows that even dominant financial systems can change. The British pound once appeared equally unshakable before the 20th century reshaped the global economy. The same forces that built the dollar's dominance, global trade, financial networks, and international confidence, could, under the right circumstances, begin to weaken it. And when the foundation of the world's monetary system begins to shift, the consequences rarely remain confined to one country. Chapter 3: The Trigger: How a dollar collapse could actually happen. Currencies rarely collapse overnight without warning. In most historical cases, financial systems weaken slowly before reaching a breaking point. Economic pressures accumulate beneath the surface until a single event, or a chain of events, triggers a sudden loss of confidence. For the US dollar, such a collapse would not likely come from one simple cause. Instead, it would probably emerge from several overlapping forces that gradually erode global trust. One of the most commonly discussed risks is excessive national debt. The United States carries one of the largest public debt levels in history. In normal conditions, this is manageable because global investors continue buying US Treasury bonds. As long as demand for these bonds remains strong, the government can finance deficits without destabilizing the currency. But the system relies heavily on continued confidence. If investors begin to fear that the debt is growing faster than the economy's ability to sustain it, they may start reducing their exposure to dollar-based assets. A large-scale sell-off of Treasury bonds would push borrowing costs higher. Higher interest payments would increase the government's fiscal burden, potentially forcing either drastic spending cuts or aggressive money creation by the central bank. In extreme cases, this could lead to inflationary pressure that weakens the dollar's value globally. Another potential trigger could come from geopolitical fragmentation. The modern financial system depends on cooperation between major economic powers. However, increasing geopolitical rivalry has encouraged some countries to reduce their dependence on the dollar. Governments have begun experimenting with alternative payment systems, bilateral trade agreements in local currencies, and digital financial infrastructure that bypasses traditional dollar-based networks. If several large economies simultaneously reduce their reliance on the dollar, the global demand that supports its dominance could begin to decline. Technology could also play a role in reshaping the monetary landscape. Digital currencies, particularly those issued by central banks, have the potential to transform how international payments are conducted. A widely adopted digital currency, backed by a coalition of large economies, could offer faster settlement, lower transaction costs, and reduce dependence on US-controlled financial infrastructure. While such a system would not immediately replace the dollar, it could gradually weaken the network advantages that have supported it for decades. Another possible trigger lies in financial market instability. Modern financial systems are deeply interconnected. Banks, hedge funds, pension funds, and sovereign wealth funds hold vast portfolios of dollar-denominated assets. If a major institutional failure triggered a chain reaction of forced asset sales, markets could experience a rapid liquidity crisis. In such scenarios, investors sometimes rush towards safe assets. But if the crisis directly involved US financial institutions or government debt, the traditional safe haven status of the dollar might be questioned. Once that perception begins to shift, even temporarily, markets can react with extraordinary speed. Finally, a loss of monetary discipline could accelerate a crisis. If policymakers attempted to manage economic downturns through excessive money creation, the supply of dollars could expand much faster than global demand. Over time, this imbalance could weaken purchasing power and encourage international investors to move toward alternative stores of value such as gold, commodities, or other currencies. Each of these factors alone might not cause a collapse, but financial history shows that crises often occur when multiple vulnerabilities converge at the same time. Rising debt pressures, geopolitical realignment, technological disruption, market instability. If these forces aligned, the global financial system could face a moment where confidence in the dollar begins to erode rapidly. And once confidence starts to break, the next phase of the crisis would spread far beyond currency markets. Chapter 4: Shockwaves through the global system. If confidence in the dollar began collapsing, the immediate consequences would spread through the global economy with extraordinary speed. Because the modern financial system is deeply interconnected, a crisis centered on the world's primary reserve currency would not remain isolated to the United States. The first shock would appear in financial markets. Currency markets would become extremely volatile as investors rush to move their capital into alternative assets. Some currencies might surge suddenly, while others could crash under pressure. Global stock markets would likely fall sharply as uncertainty spreads through investment portfolios. Banks would face immediate stress. Many international loans, corporate bonds, and government debts are denominated in dollars. If the dollar lost stability, institutions holding large quantities of these assets could face severe balance sheet disruptions. Liquidity shortages could emerge as banks struggle to maintain access to reliable funding. Central banks around the world would quickly intervene. Emergency meetings would be held. Interest rates might be raised or lowered rapidly in an attempt to stabilize national currencies. Governments could impose temporary capital controls to prevent massive outflows of money. Some countries might begin selling dollar reserves in order to defend their own currencies. The effects would quickly reach global trade. Because many commodities are priced in dollars, instability in the currency would disrupt international pricing systems. Oil markets would become particularly sensitive. Energy exporters might hesitate to accept dollars for large shipments, creating uncertainty in supply chains. Shipping contracts, commodity futures, and international trade agreements would suddenly require renegotiation or new pricing mechanisms. This disruption would not only affect governments and financial institutions, it would reach everyday businesses. Manufacturers that rely on imported raw materials could face sudden cost increases. Companies involved in global logistics might delay shipments while currency risks are reassessed. International investment projects could freeze as financial institutions pause lending. For emerging economies, the situation could be even more severe. Many developing countries borrow money in dollars because international lenders trust the currency. If the dollar experienced extreme volatility, these countries might find it difficult or impossible to refinance their debts. Sovereign debt crises could spread rapidly across vulnerable economies. global investors would begin searching for safe alternatives. Gold prices would likely rise sharply as markets look for traditional stores of value. Certain stable currencies might temporarily strengthen as capital flows toward them. Governments could also accelerate discussions about creating new international monetary arrangements. Meanwhile, political pressure would increase worldwide. Citizens would demand answers from their leaders as inflation, currency fluctuations, and financial instability begin affecting everyday life. Governments might accuse each other of destabilizing the global economy. Economic alliances could shift as countries attempt to protect their national interests. What makes such a scenario especially dangerous is the speed at which financial panic can travel. Modern markets operate through automated trading systems, global banking networks, and instant communication channels. News spreads in seconds. Investment funds can move billions of dollars across borders in minutes. In such an environment, confidence can disappear faster than policymakers can respond. Within weeks or even days, the global economy could find itself navigating the most severe monetary disruption since the modern financial system was built after World War II. And as the crisis unfolds, a fundamental question would dominate international discussions. If the dollar can no longer anchor the global financial system, what will replace it? Chapter 5. A world searching for a new financial anchor. If the dollar were to lose its central role in the global economy, the world would face an urgent and complex challenge: finding a new financial anchor. For nearly 80 years, international markets have relied on a single dominant currency to stabilize trade, store reserves, and settle cross-border transactions. Without it, the global system would enter a period of experimentation and uncertainty. One possibility is the emergence of a multi-currency world. Instead of relying on a single dominant currency, several major currencies could share global reserve status. Central banks might diversify their holdings across a group of stable economies rather than concentrating their reserves in one place. Trade agreements could begin using different currencies depending on the regions involved. In such a system, the global economy would become more decentralized. Power would be distributed among several financial centers rather than concentrated around one. Another potential outcome involves regional monetary blocks. Large economic regions could develop their own financial ecosystems, conducting most trade within their sphere of influence using regional currencies. For example, countries with strong economic ties might coordinate payment systems, reserve assets, and lending institutions that operate independently of the previous dollar-dominated structure. Over time, this could reshape global economic alliances. Technology may also influence the search for a new monetary foundation. Central banks around the world are actively researching digital currencies that could streamline international payments. These systems could allow direct transfers between countries without relying on traditional banking networks. If widely adopted, digital currencies might form the backbone of a new global payment infrastructure. However, technological solutions alone cannot replace what the dollar historically provided: deep financial markets, strong legal protections, and long-term political stability. Any currency or system hoping to replace the dollar would need to earn global trust on a similar scale. Some economists argue that a commodity-linked system could return. Gold historically served as the foundation of international finance before modern fiat currencies dominated global markets. In times of extreme monetary instability, investors often return to tangible stores of value. If confidence in national currencies declines significantly, governments might consider partially backing new financial systems with commodities or other physical assets. Yet rebuilding such a system would be complicated. Modern economies operate on financial scales far larger than the global gold supply can easily support. Another possibility is that no single replacement emerges immediately. Instead, the world could experience a long transitional period where multiple systems compete. Governments, financial institutions, and corporations would experiment with new payment methods, reserve strategies, and financial partnerships. During this transition, economic influence could shift dramatically. Countries with stable institutions, strong production capacity, and reliable financial markets would gain greater influence in shaping the new order. Trade networks might reorganize around new hubs of economic activity. International organizations could attempt to coordinate global financial stability through new frameworks. But transitions between monetary eras are rarely smooth. When the British pound gradually lost its dominance in the 20th century, the shift toward the dollar took decades and occurred alongside wars, economic crises, and massive geopolitical change. A similar transformation in the 21st century would likely be just as turbulent. As governments search for a new financial anchor, the world would enter an unfamiliar phase, one where the rules of global finance are no longer settled and where the balance of economic power is still being written.
Chapter 6. Life after the dollar era. Months after the initial shock, the world would begin adjusting to a new financial reality. The transition would not be immediate or orderly. Markets, governments, and institutions would spend years adapting to a system no longer centered around a single dominant currency. For ordinary people, the most noticeable changes would appear in everyday prices. International goods would become less predictable in cost. Electronics manufactured overseas, imported fuel, and global supply chain products could fluctuate significantly depending on exchange rates and trade agreements. Businesses that once operated within a stable, dollar-based system would now constantly manage currency risk. Companies engaged in international trade would likely change how they operate. Large corporations might begin holding multiple reserve currencies rather than relying primarily on dollars. Contracts could be written using baskets of currencies instead of a single unit of account. Financial departments would become more complex as firms navigate a fragmented monetary landscape. Governments would also need to rethink economic strategy. Without a single global reserve currency acting as a stabilizing force, countries would place greater emphasis on domestic economic strength. Industrial capacity, energy independence, and technological development could become more important than ever. Nations able to produce critical resources internally would have a stronger position in global negotiations. International institutions might attempt to rebuild financial coordination. Organizations that oversee global finance could push for new agreements designed to reduce volatility and stabilize trade. These frameworks might include shared reserve systems, coordinated currency policies, or new mechanisms for resolving sovereign debt crises. Yet the geopolitical consequences could be even more profound. For decades, the dominance of the dollar has given the United States significant influence over global finance. Many international transactions pass through American financial infrastructure, and sanctions or regulatory policies can shape economic behavior worldwide. In a post-dollar world, that influence would likely diminish. Power would become more distributed across several major economic centers. Financial alliances could shift, and new economic partnerships might emerge in regions that previously operated within the dollar system. Despite the disruption, the global economy would not simply collapse. History shows that financial systems evolve rather than disappear. Trade would continue, innovation would persist, and new institutions would gradually form to manage the changing environment. Over time, a new balance would emerge.
Just as previous generations adapted when the global system moved away from gold, or when the British pound lost its financial dominance, the world would slowly construct another framework to support international trade and investment. But one lesson would remain clear. The strength of any currency ultimately depends on trust. Trust in institutions, trust in economic stability, and trust in the future value of money. When that trust is strong, a currency can support a vast global system. When it weakens, even the most powerful financial structures can begin to shift. And in this imagined future, historians might look back at the early 21st century as the moment when the world's monetary center quietly began to change. Because in the end, the fate of a currency is not decided by numbers on a screen, but by the trust billions of people choose to place in it.